Hey everybody, Scott Dennison here with Finance Fridays, where we talk about different tools, ideas, and strategies that you can use to get ahead financially. So, because I'm a licensed mortgage agent, today I thought I'd talk about 5 very important things that you have to know before you go out and purchase your first home. So, for a lot of people, their first home is going to be one of the biggest purchases they've ever made. And as such, their first mortgage is going to be one of the biggest amounts of debt they've ever had on their books. So that can be stressful for some people, especially if you don't know too much about what that mortgage means and how to work it. Let's dive in. Let's talk about 5 important things that are going to help you understand your mortgage better. Here we go. Okay, so the first thing that I want to talk about that's very important for you to know is that there may be other options that are available to you besides your bank that will help you get your mortgage, right? So first let's talk about your bank. And this blue circle, let's just pretend that this is your bank. This is your financial institution that you use all the time to do your banking. So there are a couple really good reasons why your bank is a great lender for you. Number 1, they have a lot of data on you, okay? They've got your credit card information. They've got your bank account information. Big Brother is watching you. Seriously though, they have a lot of information on you which allows them to judge your credit risk differently from the other lenders that we might be able to bring you to. So that's your bank. Now, the thing that you have to realize about your bank is they only have their lending products. And they have a certain box that they have to put all their borrowers into, right? So you might not fit within their box. And so as you start to look at different options that are available to you, you realize that there are a lot of different options, right? There's B lenders, so people that look at different or, slightly riskier credit profiles than your bank might look at. There's credit unions, there's other banks. Other banks have different lending programs or lending options that are available to you that your bank might not have. And then of course there are private lenders, so people that are going to charge a little bit of a higher interest rate, but deal with riskier mortgage transactions. So there's lots of different options that are available to you, and really that's the biggest, that's one of the benefits that we as mortgage agents provide to you. Don't think of us as mortgage agents or brokers as competition for your banks. We're not. We deal with a lot of the banks that you're probably a member of. So the best thing that we have to offer to you is we help you look at your entire financial picture, and we help you decide, okay, this is a good roadmap for you financially to get to where you want to go. And that's my favorite part of the job is helping people find the best options that are available to them. Maybe the best rate isn't, what they're looking for. Maybe an interest-only loan is good for their situation at this point, rather than a regular mortgage, or a line of credit rather than a regular mortgage. Maybe a B lender or a private lender suits their needs better. It really depends on each person's individual situation, and us as mortgage agents or mortgage brokers really work with you as a client to figure out what your situation is and determine which of these lenders is best to go with. And maybe for you, we determine that going to your bank is the best lender. But at least by coming to us, you're able to look at all the options that are available to you. So that's just my quick sales pitch. On to the rest of the video. So the second important thing that you need to know before you go out and start looking for your first mortgage is what it's going to cost you. So a lot of people think, okay, I have the 5% down payment saved up, we're good to go. Let's get this mortgage rolling. Hold on a second. Let's take it back a step. So that's very good. If you got your down payment, that's excellent. So normally in Canada anyway, the minimum down payment that you can have for a first-time home buyer is 5%. If you're not a first-time home buyer, the rules are a little bit different. But for a first-time home buyer, and there are a couple people that can do this kind of mortgage, 5% down is the minimum that you can have. And that down payment either has to come from your own resources, so cash in the bank, save cash in your savings account, or things like RRSPs, other investments that you can take out and turn into your down payment, or it can come from a gift from a family member. There's also closing costs. So if you are involved in a 5% down transaction, which is what's considered a high ratio mortgage transaction, oftentimes the lender is going to ask you to make sure that you have 1.5% of the total mortgage amount in either cash or gifted money to cover things like closing costs. And your closing costs include legal fees, so the cost of doing business with your lawyer, to transfer the title, to disperse the funds of the mortgage. It's going to include things like lender fees and broker fees. There's not always lender fees or broker fees, but depending on the lender you go to, there might be different fees there that are involved in the mortgage transaction. Appraisal costs. Sometimes, if you're buying your first home and it's a private sale, like there's just a sign, a spray painted sign on the front lawn that says this house is for sale, and you knock on the front door and you want to buy that house. Well, the lender has to make sure that you're buying that house for a fair market value, right? So in those cases, they might ask for an appraisal. If it's an MLS listed deal, so if it's listed on the MLS, they might waive that appraisal, the need for an appraisal. And then the final thing that might be included in closing costs are inspection costs. Normally before you sign on the dotted line and close the real estate transaction, you want to have a home inspector go in and make sure that everything's fine. There may be other closing costs available, but just remember, if you're doing a 5% down mortgage transaction, the lender will often ask to see that you have 1.5% of the total mortgage amount in either cash or gifted money to cover your closing costs. Very important. On to number 3. All right, guys, so number 3 is we'll talk about mortgage language. What are all these terms that your mortgage broker, mortgage agent, or banker is talking about when they're giving you your first mortgage? So I'm just going to talk to you about 4 terms that I think are very important in dealing with your first mortgage here today. There are a number of different terms. If something comes up that you're not too sure about, feel free to reach out to me, give me a call, send me an email, and we'll go over it with you. The terms that I want to talk to you about today are the term of the mortgage, the amortization of the mortgage, open versus closed, and then fixed versus variable rate. So first we'll start talking about the term. So back in the good old days, you used to go into the bank and the banker would just say, all right, you got a mortgage for the next 25 to 30 years. Good luck. Hopefully you pay us back. I mean, it was a little bit more complicated than that, but the term of the mortgage used to be 25 to 30 years, or however long it took for you to pay the mortgage all the way down to 0. Well, the lender is starting to realize that's a little bit risky, and that's, it's hard to have your capital, your money, as a lender locked into one particular client for that long. 25 to 30 years is a really long time. So what they've decided to do is they've shortened it into shorter terms. So basically you can think of your mortgage term as the length of this particular mortgage contract. A lot of the times these days you'll see a mortgage term between 1 and 5 years. And so what that means is you're locked into this particular mortgage contract, these set of rules, this interest rate for however long the term of the mortgage is. It might still take you, 25 or 30 years to pay off the full mortgage, but for this particular contract, it's between 1 and 5 years. So at the end of the mortgage term, you can do a couple different things. You can either pay off the mortgage in full. If you can, good for you, that's really awesome. You could just renew the term of the mortgage with the same lender, same rate, or whatever rate they quote you at the end of that term. Or you can refinance, but that's a different story for a different time. For now, we're talking about buying your first home. So that's the term of the mortgage. Now, it might still take you 25 to 30 years to pay off the mortgage, and that's what's called your amortization. So amortization is basically keeping the same interest rate the same, keeping the same monthly payment, how long will it take you to pay off the mortgage in full? So you'll see, say, a 5-year mortgage term, 25-year amortization. What that means is, under this particular mortgage contract, paying, for example, 2.5% interest, $500 a month, just to keep it simple. If you continue to pay that $500 a month, it's going to take you 25 years to pay off that mortgage. So what's really interesting is that you need to consider the relationship between amortization, your monthly payment, and the amount of interest you're going to pay over the lifetime of your mortgage. So this is how it works. The longer your amortization period, the smaller your monthly payment is going to be, and the more interest you're going to pay over the lifetime of that mortgage. Now, if you shorten your amortization period, you're going to end up paying a little bit more per month, and you're going to pay less in interest over the lifetime of the mortgage. So that's something that you can work with in setting out your mortgage. You know, if you need a smaller payment to make it affordable for you, extend the amortization period as long as your lender will let you extend that for. If you want to pay it off quickly and really see the amount you owe go down faster, shorten that amortization period. All right, so these, you know, that's an important thing to know about. Then we got open versus closed term mortgages. So what this deals with is, how easy is it for you to, you know, pay down the mortgage in advance or pay off the mortgage before the term is up. So think of your credit card as an open term loan, which means you can put as much money down on your credit card or any kind of line of credit that you have at any time. So if I get $500 tomorrow, I can put that right towards my credit card, no problems, no questions asked, right? So that's what's called an open term. So it makes it a little bit easier to pay off your mortgage sooner or make payments in advance before the term is over. Now, closed term mortgages are when it's a little bit more strict. You can only pay down a certain amount every year, and you can only pay off the full amount of the mortgage if you pay a certain prepayment penalty, right? So what that means is you're going to be, you can't just take that $500 and put it against your mortgage. It doesn't really work that way. You just have to make your set monthly payments, and then they usually give you allowances on, okay, you can pay down 20% of your mortgage this year in addition to your monthly payments, and you have to pay this penalty if you're going to pay it off before the term is up. So that's a little complicated. If I didn't explain that properly, feel free to reach out to me and I'll try to go over it again with you, okay? Final term I want to talk about is fixed versus variable rate. So this deals with the type of rate that you're going to get for your mortgage. So fixed rate is simple. It's basically saying, okay, for the next 5 years, say we lock in for a 5-year term, you're going to have the exact same interest rate no matter what happens in the market. So for the next 5 years, for example, you'll have 2.5% as your interest rate, okay? And that's great for a lot of people, right? That means you know exactly what your interest rate is going to be. You don't have to worry about it going up or down. But then, for some other people, it might be better to have a variable rate just in case rates do go down, and then you can benefit from that. So variable rate is a rate that fluctuates throughout the term of your mortgage depending on what's called the prime rate. And the prime rate is a rate, it's a very good rate that the banks have, and basically think of that as a benchmark rate. So you'll normally see variable rate mortgages quoted as prime plus a half or prime minus half. And what that means is basically the prime rate plus 0.5% or plus or minus 0.5%, depending on what your lender is willing to give you. So it could be good because you end up, if prime rate goes down, you'll end up with a better interest rate. But it's also something that you have to monitor and keep track of. So those are the mortgage terms that I want you to be familiar with. If you have any more questions, feel free to contact me. And let's move on to number 4. 4 is the 5 C's of credit, and this is how your lender is going to qualify you to determine if you are creditworthy and to determine if they can lend you the money. So we call this the 5 C's of credit, and they're the particular things that the lender looks at. So the 5 C's are credit, collateral, character, capacity, and capital. So let's just break these down a little bit. Credit. Basically what credit is, it's a score that you get from either Equifax or TransUnion, so just 2 credit scoring companies in Canada, and it tells the lender if you're a higher risk client versus a low risk client, right? So it tells them how you deal with debt. So what the credit companies do is they look at all your debts, they look at your credit cards, your lines of credit, your car loans. They even look at not utility bills, but phone bills. So make sure you're paying your phone bill on time, okay? Because it's something that factors into your credit score. And so they'll look at how you deal with your debt, if you're paying your debts on time, if you've had any missed payments, and they're going to spit out what's called a beacon score. And the beacon score is going to tell the lender, what kind of creditor are you? So if you have a 680 beacon score or higher, that's where the lenders will consider you to be very low risk, right? So, so if that's the case, good for you. You're going to get some very good rates. Great job keeping your credit score nice and high. If your credit score is below 680, not the end of the world. Not the end of the world at all. There are a lot of options available to you if you're a medium or even if you're a higher risk client. So just, if that's you, feel free to give me a call and we can talk about what your options are. So don't worry if you have a lower credit score. Collateral is the second C of credit. And this is basically the asset, or in your case, the property or home that the lender is going to secure the mortgage against. So the lender is going to look at a number of different factors that play into the house, and what they're looking for is to see how marketable that property is going to be for them if they ever have to sell it to make their money back, in case of default or something like that. Character and capacity. So these are the things that tell the lender, are you able to make your monthly payments and pay back the mortgage? And are you willing to make your monthly payments and pay back the mortgage? So capacity is are you able to? It's things like, where's your income coming from? What type of income do you have? Do you have sufficient income to be able to make those monthly payments? And then character is largely based on how you've handled debt and credit in the past. So they'll look at these factors and determine if you're the type of person that they want to lend their money to. And then finally, it's the capital. It's the money in the bank. It's the money that you're going to spend in order to purchase your first home. So they want to know how much of a down payment you're willing to put forward, where that down payment is coming from, and do you have enough skin in the game to show them that you're dedicated to making this real estate transaction work. So those are the 5 C's of credit, and that's how they're going to determine if you are the person they want to lend their money to. So the fifth and final thing I want to talk to you about before you go out and get your first mortgage is the mortgage process, okay? So I'm a mortgage agent. I've never worked in a bank before becoming a mortgage agent, so all I can speak to is our mortgage process. So this is how our process goes. So you come to us, we collect some of your information, and we go through what's called the pre-approval process, okay? The pre-approval process. And you should always do this before you start looking for your first home, because the pre-approval process is going to tell you how much you're able to go out and spend on your first home. So you come to us, we get some information, and we say, okay, based on your income, based on a number of these different factors, you can go out and look for a house in this price range, okay? So a pre-approval is not a final approval. The lender the lender's looked at your file and said, okay, based on these things, we'd be comfortable with this client getting a mortgage from us at, say, $500,000, right? but they haven't underwritten the deal yet, which means they haven't looked at all the facts, they haven't looked at the property, they haven't given you a full approval yet. So be very careful. Just because you have a pre-approval does not mean you were approved with that lender yet. So whenever you go out and you do your, so you get your pre-approval, and then you shop and you're looking for houses, you find the perfect house. It's got everything you're looking for in your first home, right? You sign the contract for that property, you get what's called a purchase and sale agreement. And in that agreement, make sure you give yourself at least 5 to 7 days in order to waive financing. So what that allows you to do is it allows you to come back to your mortgage agent or mortgage broker with the purchase and sale agreement, with the MLS listing if you have one, and say, okay, I found the property, let's proceed with the final approval process, which is very exciting. It's just another step along the process. And so make sure you get that financing waiver, because it's going to take a little bit of time for the lender to say, okay, great, we like you, and then examine the property, look at, underwrite the deal. And so during that time, once you found between when you find the property and you waive your financing conditions, the lender is going to look at the deal, is going to say, okay, we approve you, but it's going to be a conditional approval, okay? It's very rarely just going to be, okay, you're good, you're done, let's do this. It's going to be an approval based on certain conditions. So it'll be things like we need to get an appraisal. It'll be we need to get certain documents to prove the things that you've stated on your application, right? Like things like tax documents, like notice of assessments, or property tax documents, or letters of employment, things like that, right? So during that period where we're getting the approval for financing, you're going to get a conditional approval, and we're going to satisfy all the conditions that the lender lays out for us in that approval. So do not waive your condition of financing until we have an approval, a final approval from a lender, and we've satisfied all of their conditions. So we should be able to do that between 5 and 7 days. Once you've satisfied all the conditions, that's awesome, that's really good. You waive your financing conditions, and then we've got the closing process. So usually in this type of transaction, it's a month or two between when you waive financing conditions and when you close. And normally that's because the seller has to move all their stuff out of the house, and you also have to deal with your lawyers and do all the paperwork, right? So that's what most of this closing process is going to be. Now understand that when we're dealing with our lenders have the right to ask for additional documentation anytime, between when you get the approval and closing. So if they ask for additional documentation, we just have to be quick to get it to them, right? So that's part of our process. That can be frustrating for a lot of people, but that's why I'm trying to get it out there now in this video, so that you're not surprised by it when they ask for it down the road. But that's the closing process. A lot of it is just working with your lawyer to finalize the financing, finalize the transfer of title, things like that. And then closing date comes along and you get your keys and you turn the key and you've done it. So that's the mortgage process. That's how we deal with it anyway. I'd love to hear about how other people's mortgage process has gone, so that I have a better understanding of how different people do it. And that's the video. Those are the 5 important things that I want you to know before you go out and get your first mortgage. So again, I'm Scott Denniston. I'm doing this Finance Friday, and I hope it's interesting and I hope it's useful to you. Please subscribe. That's really weird, I'm pointing towards the floor right now when I say that, but please subscribe to this channel, and I hope I see you again on Finance Fridays. Thanks a lot.